Okay, well, it's a pleasure to be here again for the 7th year. I'm going to go more to the virtual life of the investors and try out of the real life of construction and mining, etc., and try to explain how we try to make money here, how we understand commodities, how we treat this world in order to make solid investments. So this is the content of the presentation. So to sum up that, I'm going to divide the presentation in 6 parts, a couple of slides on us, then the basics, which is interesting because what we learn from the value philosophy, we have transferred it to commodities, so we are kind of different in this aspect. Then investing in commodities, the third part will be what we have learned, basically via making mistakes for 20 years. Then fundamentals, I will touch on fundamentals, how we look at the industry, how we value the sector, how we value the companies. Then I will go to the Natural Resources Fund, what is our current positioning, because this is dynamic. And I will focus on the main investments and our proposition, which is based on Warren Buffett. Our proposition is partnership for investors and for companies where we invest. We want to be in the long term, generate value, and have a nice path. So us, a couple of slides only, we are small, we are a boutique, and we want to stay as a boutique because we think that the institutionalization is going to damage returns and the way we work. So we really like what we do. 250 million, we are regulated by the FINMA, 4 investment professionals. I will go in detail there. Our strategy investment philosophy is very clear, strategic value. Basically, we look for quality at a good price, at a cheap price, and we are long-term investors. We do not speculate, we do not time the market. We try to buy cheap, good assets. Performance is good. So far is kind of confirming our strategy. Past 5 years for the classic, which is the other fund, the global value, 12% per year in the past 5 years. Natural resources, also 12% per year past 5 years. But the natural resources has been more challenging because, as we have said, the cycle has not really taken shape yet. So it has started in our view. In our view, the new commodity cycle started 2019, 2020, but we are in the early innings, and the soft economy has delayed a little bit what is going to happen in the next few years, we think. This is the team. So 3 messages here. We have a lot of experience. So Carlos Jarillo, the founder, Harvard University, professor in the university. He's written several books about the strategy. Urs, he worked for Zulab Asset Management in the natural resources space for many years and did very well. Alex has been also portfolio manager in his past and works for SIA since 2005, so a lot of experience in management. And myself, ex-Merrill Lynch, and also with experience in research and asset management. So this is important because in this sector, experience, in our opinion, is key. So a lot of experience, and we have seen cycles up, cycles down, companies up, companies bust, and everything. We are invested in the funds, all of us, and we are fast in decision. So institutionalization here doesn't help. If you need your boss to communicate to the other boss, and then the top boss thinks that China goes down, this is game over for this fund. So we don't buy or sell on China. So this is our basics. It's what we call the 4 Gs. This, we implemented it in the value fund, in the classic, and it's basically in the classic, it's good companies, good managers, good balance sheets, and good price, so cheap prices. Here, we look for quality assets. It's not really a company. When we buy in natural resources, normally we are buying miners or E&P, so oil producers, and you need to look about assets. Assets mean look for, this is what we do in order to add value, look for low cost, we look for low capital invested, we look for long life. You need to go through the reserves and the resources and check them. You need to go to the infrastructures. There's a mine called El Pachón that Glencore mentions from time to time. This mine is in Argentina, but they cannot really build it because the transport has to be done via Chile. So the mine is worth 0. unless you convince the Chile that you can transport via their country, which probably you will need to pay. So these type of details are very important in order to assess the quality assets. Obviously, exploration potential in an oil company, normally you have the 10 years of reserves. You need to see if they will be able to bring new, because in the end, normally you see 5, 10, 15 years of life, and then they have resources. So you need to understand if really you can extend the life of the company, and a good technical team. This is the example of Atalaya Mining, how detailed is the review on the cost. So you have the mining cost, the processing cost, site, non-site, freight, and cash cost. And to the cash cost, you need to really add the sustaining capital in order to keep the thing growing. So all this analysis has to be done in every aspect of the investment. So quality assets, main message, very, very important in this business. Quality managers, I like to repeat this sentence from Mark Twain again. A mine is a hole in the ground with a liar on top. And this is really what we have experienced over 20 years, is managers really emphasize how good their assets are because they need the capital. And they will do it with good reserves or with bad reserves because it's their life, it's their investment, and they will do it. And also Stanley Druckenmiller talking about the Texans, that if you give them money, they will drill. And in the end, we look for experienced people that know the commodities, that have track record, that understand the sector. You would be surprised, there are managers out there that do not really understand the cyclicality of this sector, because they've been there maybe 5, 10 years. You need to see several cycles to understand how tough is a downturn, and align with minorities because, the alignment with minorities in this sector is really tough. And just as a summary, and then you may remember, I'm not too good at telling jokes in English, but this joke comes from an annual letter from Warren Buffett. There's an oilman that dies, unfortunately, and he goes to heaven, and then St. Paul says, you had a good life, you can enter in heaven. And then he says, but I have bad news, the place for oil explorers is full. And then the guy says, can I say a word to these guys? And then St. Paul says, okay, you can say a word. And then he jumps in and he says, hey, there is oil in hell. And then every oil man goes out, and then it gets empty. And then St. Paul says, wow, you are a clever man. You had a good life. You can just enter. And he said, you know what? I'm going to check if this rumor is right. So this is exactly what we feel after talking to many, many people, is that you need to talk to them. You need to hear what they say, but be very careful because they need the money. Avoid leverage. We've read Warren and Charlie and value investors, but you don't learn what happens with leverage until you invest in a company like in this case. This is Harbour Energy before Premier Oil, and this is the result of leverage. If you buy a company that has debt in this sector, you have what we call the toxic cocktail, which means you have volatility in the commodity. Oil price, gas price moves up and down a lot because of elasticity or inelasticity. You have operating leverage because fixed costs are relatively high on average. So if price of the commodity goes down, profit disappears. And then if you add financial leverage, it's a matter of time that this happens. We're talking, I think, about 100 pounds in the peak. And the stock is now 400 pence or 300 pence. This is the last price. So this we have learned 1, even 2 times, and it will not happen again. And the 4th pillar of our investment is buy cheap. So good business, good assets, good managers, no leverage. In this industry, no leverage is key because of the vola and the long duration of the cycles. Buy cheap. This is why we think we are a bit different from the rest of the natural resources guys. We value all the companies, as you know. We build DCFs and intrinsic values and returns for every company we have. Again, following a little bit the advice of Warren that he suggests to have a valuation for every company. And we buy below mid-cycle valuation. As the sector is so volatile, you need to calculate what is the average value of the company on mid-cycle. If you value one of the miners or the oil guys at high oil prices, it will always be cheap. So it's only, you can only really value them at mid-cycle, try to buy them at a discount and sell them when everybody is bullish and oil price is going to go to 300, then you sell. And the fund, as Alex was mentioning, is trading at nice numbers now, nice multiples. Yeah, 4% dividend yield, low PE, low price to book. I will enter in detail later on. I'm also getting older. I'm going to change my glasses because I don't see anything. Now, okay, much better. So this is our pillars. We will not move it from this going forward, looking for quality. What we learn? Well, I think the example of the tunnel of the Gotthard was perfect. So we need a very long-term approach. These projects take a decade. You cannot really invest on a 6 months approach. And the market, the equity market, you know very well, we are all of us very much moved for the short term. Here we need to invest for a cycle which is going to take 10 years, 15 years. And this is, the picture is from Grasberg in Indonesia that I like to put. This used to be a mountain. It was discovered in the beginning of the 20th century, so we've been operating for 50 years plus, and it's still working. And I think the altitude is above 3,000 meters. So, you know, we are not talking about small projects. We're talking about 10, 15, 20 years when you ask for the permission or you discover the ore, and then you start first production. So very long-term approach, safe jurisdiction. It is not easy to invest in safe countries here because most of the resources are in emerging markets. Even if you invest in developed markets, then you see unexpected taxes or unexpected nationalism regarding resources or ESG environment issues. So really what we try is to look for companies that overall are in safe jurisdiction. It is not possible to do fully because, as you see, in processing, China is a very big player with more or less 50% of everything. And in extraction, you have the US and Russia in oil and Saudi Arabia, obviously, natural gas, US and Russia, Middle East, copper, basically Chile, a little bit Peru, nickel is Indonesia, cobalt is Congo, so on and so on. So it's very concentrated and some of the geographies are risky. So you need to try to, so as an example, I think I put here a couple of examples. Yeah, well, Glencore would be a good example. They are diversified and some other companies. We also have a list of non-investable countries. So there are countries we will never invest. Argentina, Russia, and China are examples, with all respect. Avoid startups. This sector has too much risk in order to invest in startups. So we also made this mistake. If somebody would tell me now this, I would probably invest again in Northern Dynasty. We invested in this name many, many years ago, and look what happened to the stock price. We're not talking about 8% performance or 6% performance, you go to zero. And you know, startups, I think they are more suited for big companies, for majors, for governments, for private equity, because it's a long-term project with a lot of risks that the equity market will not bear. So in Northern Dynasty, we decided to sell. They have a fantastic project in Alaska, copper project. One is a tier 1 project in Alaska. We thought they would get the permit. So when the stock price goes up, it's because the cycle is good and the expectations of the permit improve. When prices go up, expectations also improve, which is kind of psychological of the market. And then ding, 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 moving to zero because they need funding. So they need, every year they do a capital increase, we would have lost everything. Avoid majors. This also we learned in the past years, decades. Majors are very diversified. They need to replace reserves that are very large. The marginal return is lower, obviously, because they need to replace these reserves that were found 2 decades ago. They have a lot of institutional constraints. They want to be green. They want to produce electricity from wind and this stuff, and marginal return goes down. very large to grow. Obviously, growth is not important here. And normally they acquire companies, and normally they acquire on the peak, on the cycle. So they normally destroy value by acquiring the other guys at much higher prices. So this is why I put this chart when you can compare the I think it's CNQ and Shell in the past cycle. So I think, or we think, that we can make much more money in the mid space of the sector, not the majors, not the startups or small guys, but in the middle. Invest in companies, do not invest in commodities, and this is the chart is clear. I think it's over 15 years, so it's long term, and it's the comparison of the MSCI energy with WTI, with the oil price. One is negative, the other one is positive by mid-single digit. And it's normal because companies do things. Companies, they reinvest, they find projects, they cut costs, they buy back shares, they pay dividend. The good guys, they buy in the trough and they do nice projects. So normally, it's much better if you want to play the commodity cycle to invest in companies. They will do the job of trying to time the market for you. And final here on our learning is vola. So this sector is super volatile. Why? Because it's macro-driven, because everybody relates. So there's a direct relation with the consumption from China, which is basically 50% of the consumption of these commodities, and then macro. No? If the US goes well, copper demand goes well. So there's a direct link here. Volatility is very high. All the traders use this sector to make money short term. So when there is fear that China goes down, that the US goes down, everybody sells the sector, which is what is happening now. So high vola, high beta. For us, it's very interesting because vola is an opportunity to buy cheap. And I'm putting there what happened with our fund. You remember in COVID, in 2020, recession, we are going to die, markets collapsed 35%. These shares, this is Hudbay Minerals, 2 times beta, so a beta of 2 times. If the market falls 35, this falls 75. And at this time, we buy. So for us, it's difficult because you see the NAV and you say, whoa, what is going on, Marcos? The fund is down 40%. So we are really sad for that, but it's the time where we buy up to this, because the long cycle is not changing. And this is why the fund has multiplied by 3-point-something times in only 4 years, because in the low of the COVID, our discussion was what to buy. You know, it's like having things at 30% replacement cost, 30% book value. So the idea was, well, let's place the book in order to enjoy this, but without not too much risk. So this was a little bit sharing our experience and how we try to position ourselves. Let's go to the fundamentals, how we analyze the sector. So it's a long cycle. I don't think I need to explain it again. So when there's an investment cycle, you have new supply. New supply normally is higher than demand. Prices fall, investment disappears, and this starts the new cycle. Prices go down, no investment, then prices start to go up, new investment, 15 years, 10-year cycle. Previous cycle, 2002, 2011, downturn 11-19. We think that the new commodity cycle started in 2020 with the COVID. Obviously, with the COVID, it was the low, but in 2019, 2020, we were already sure. How long will it take? 2020 to 2030, we are in 2024, but still the economies have not recovering. So still the cycle is not, the US is slowing down, Europe is slowing down, China is slowing down. So it's going to take a decade. Very important to have supply-demand analysis per commodity. So it's not an easy sector. You need to have an analysis per commodity. And you need to really, the basis for our investment, really the one message that everybody should retain in this sector is understand the underspending cycle, which is what is going to create the new cycle. And so far, underspending has been here, and we have seen in several slides, have been present since 2012, 2013. So already 10 years of underspending. We focus on scarcity. This differentiates us from passive and institutional, because an institutional manager needs just to keep the job. So basically, they have the index of natural resources, and they do not deviate too much, because if you deviate for 3 months, you're out. What we can do it with your, with your support, we can do it. Passive is the same, is the index, so they will do index minus cost. So what we focus is on the supply commodities, not paying too much attention to indices, and we have developed a fund that is a bit more flexible. If at some moment oil price goes to 200 and oil companies triple, we will be able to take money from oil and put it in other sectors. I will try to explain what are these sectors that we have as a levers, because if you run an energy fund, you cannot escape. You can go to cash, but everybody wants to be invested. So this is the way we found in order to be flexible. Which are the commodities we like? Copper, oil, uranium, salmon. We think there is structural undersupply in these 4. Can be wrong, but this is our numbers now. In aluminum and nickel, there is supply, but demand is going to grow so much that the cycle will be very interesting. And the commodities that are well supplied are coal, met coal, natural gas, iron ore, and zinc, in our view. So at these commodities where the cycle will be the normal, in our opinion, will be the normal one, we will be only buying when prices are very, very low and valuations follow these prices. How do we determine the commodity prices? So you need to value a company. Here, you need to understand what is the low. So what is the commodity low is the marginal cash cost. You can see on the left-hand side for copper, what is the marginal cash cost, which is the most expensive mines in the world that have a high cash cost. If the price falls, these ones need to reduce production or shut down at some point because they are losing money on a cash basis. This fixes the low of the price, because when the price goes down, if you see in the crisis of the COVID in 2020, and you see the crisis of 08, 09, you see that the prices fall, the copper price fall, but when it arrives to the cash cost, then the marginal supply slowly exits, and this sets the floor. So we calculate and we use this to see what is the downside. Mid-cycle prices, well, all the models need to be done, or if you want to value the companies, you need to calculate what is the incentive price. So in this case, it's copper again. You put the the new production or the new mines here, I think is per country, and you see if you need to bring new supply, what is the price required to cover the cost and make a decent return, which normally is 10%, normally 10%, maybe 15% in countries that are more complicated. And here you go to the 90% of the curve, which is normally where the price sets that incentivize the next mines to come. In copper, this price is around 9,000 per ton, which would be $4.5 a pound. This would be the price where the market slowly would bring new supply. Slowly means 10 years in copper. What is the high price? Imagine that we don't have copper now and we need to build cars and houses. Well, we'll go very high because it is very inelastic. We use 7. So I'll give you a range of prices for copper. Would be cash cost, in our opinion, is around 3. Incentive price, 4.5. High prices, 7. If this happens, really there is a shortage of copper, shortage, as it is very difficult to bring new supply, price will go very high. What will we do? As we have valuations for the company, we will sell. We will not run this thing of copper forever, ever at 7. No, because prices will follow the copper and then we will sell and we will move to another commodity. And this is a way we think we can avoid then the downturn. How we value the companies, I don't want to bore you to death, but basically it's very, very interesting to do all the calculations per unit. So incentive price multiplied by volumes, look at the cash cost, look at the capital employed per unit, and then you can calculate margins and returns per unit, and then you can compare among the different companies. All at mid-cycle. It is useless, in my opinion, to try to estimate the cycles up and down. Estimating 3 years of good cash flow, 3 years of bad cash flow, very complicated. Normally you miss, but I mean, maybe if you are very clever, you can try to do it. We do DCFs, and all this is what we call the 360. We don't like to rely only on one valuation. So we have all these multiples built, and then this is more resilient. The more valuations you have, the more resilient the model is. And this is only one input. So our investment cases, our investment decisions, and when we discuss in the investment committee, valuation is only one input. So there's risk, there's quality, there is upside, there is downside. Check with experts and do not trust them. So, you know, I remember, and this I think I told you already last year or the previous one, when shale oil appeared after shale gas, we were discussing, well, is this important, not important? Then we hired or we paid a lot of geologists via external people to talk to them. And I remember we had, I don't know, a lot of conversations with geologists, and they say, well, shale oil is not going to work. And shale oil has brought 10% of the supply of the world 10 years later of these geologists checking. So, you know, there are, first, they can be wrong. Second, there are other aspects, like in the US shale, where the shale oil guys, by promising growth and returns, they got financed. And they got financed hundreds and hundreds of billions in a project that is only profitable now. So, you know, yeah, check with them. It is complicated. You have viscosity, you have permeability, you have temperature, pressure, grades. I mean, it's really, looking at resources, you can spend years. And then, you know, common sense sometimes is even more important, but you need to check with the experts, and we do. So let's move to the natural resources. So within this kind of broad approach, I'm going to touch about the natural resources fund that we manage for many, many years. This is the valuation of the two sectors that are the main components, materials and energy. Energy is really cheap, 10 times earnings, 1.6 times book. And materials, which is basically metals mining and steel, it's a price to book 1.9 versus an historical of 2. So if you take the book value, which is more stable, materials or mining would be 1.9 times versus 2 historically, so still a little bit below, and energy well below at 1.6 times versus the historical 2 times. So this is why when people ask, because the fund has tripled, and then people ask us, hey, is this over? It's not really over, eh? It's still cheap on that basis. And you know, my experience is the sector trades between 1 times book value in the trough and 3 times book value when the cycle is super hot. If I take the book value per share of the fund, it's relatively easy to calculate what would be the mid-cycle, the high and the low on that basis. So the book value here is 120 more or less. If I apply 2 times, that is the average, we should be trading at 240, and the fund is now 160, 150 highs, 160. So, you know, still very cheap versus the mid-cycle valuation. And if I apply peak valuations, we should go to 350. So let's see, I think the message here is we don't think the cycle is over. We think we are in the early innings, as Alex was saying. What is our current positioning? So in the beginning, we thought about our super cycle. Now we are more selective. Oils, 25%, copper, 25%. Salmon is something that we use as also something to diversify a little bit the fund, because you can hide in salmon when you think that oil is very expensive. And we are bringing other subsectors in order to be able to move from sector to sector. Cables, we have 7%, electric cables. And this is why we found 4 levers to manage the fund in future cycles or sub-cycles: energy, metals, infrastructures, and agri-food. So if you recall, last year we were heavily invested in cement. We have sold a little bit because cement has moved up a lot, and we are buying a lot of salmon because salmon is down. It is very important to find these spaces where, when the cycle will be very hot in copper and oil that normally are correlated, we will be able to either move a little bit to cash and find other subsectors like cables or, we have food casings, things that are related to natural resources, or cement that are not kind of in the main indexes, let's put it this way. Top 10 holdings. We are concentrated, as you know. We know us, you know us, sorry. On the Classic, we have normally 30 to 35 names, here a bit more. Normally we have 40 names. No more really than 5% because you have many risks per company. We don't like to be very concentrated in this space because you can always have a new tax, for instance, that you cannot expect. So here are the main positions: Harbor Energy, oil, TGS is seismic, Tech Resources is a new player in copper because they sold met coal, First Quantum Copper, they got the mine in Cobre Panama stopped by the government, Leroy Seafood, Salmon, and then on down you see the three oil players: EOG, Occidental, and Aker. So it's not the main index. This is not the main index, and in 10 companies you can see 42% of the fund. So if anyone wants to go in detail, you can go in detail and take a look. As we said, price now is a bit lower because last week was a disaster. 168 is the price of the fund. Intrinsic value is 240, 2 times book. And this is not calculated on 2 times book. It's calculated on an average weighted average for the portfolio, and the return is around 14% now. You need to deduct the fees from this return. I'm going to go to the 3 main commodities we're invested in to try to explain the investment case. Oil would start first, and demand of oil. And here there's a big fight because there's a lot of people that think that oil demand is going to go down because of electric vehicles and stuff like this. And as Carlos was mentioning, we don't see this happening. We think that demand is going to be back to the long-term trend. In any case, if you look at the long-term, 1.3 million barrels a day per year was the trend growth, and it has increased to 1.4 in the last 20 years. So 2020, you see the COVID impact, and now we are slowly back to the trend. Why we think that is going to continue growing at least for the next 10 years, at least. More or less we use 1 million barrels a day, which is 1%. Now, supply and demand now are more or less 100 million barrels a day. So it's easy to make the numbers. Demand in our numbers will grow by 1. Why? Because out of the 5 parts of the world that have 1.5 billion people, developed markets, China, Southeast Asia, India, and Africa, it's strange, or it's a coincidence, but all these 5 have more or less 1.5 billion. 4 of them are growing in terms of oil demand. In the 4 end demand sectors, 3 are growing: jet fuel, chemicals, and diesel transport. And our EV penetration model, electric vehicles, we did a model a couple of years ago to track the penetration of electric vehicles. We don't see the peak. Even with aggressive penetration, we don't see the peak demand in passenger transport until 2035. So, I don't want to do estimates until 2050. In the next 10 years, the demand will be higher. And Exxon, I think a couple of weeks ago, went out saying that in 2050, demand will still be 100 million. If you see some of the estimates out there, you see people estimating 50 million barrels. I mean, it's nuts. As Carlos, I think, has proven, it's going to be very difficult, and we don't see the peak demand until 2035. I think it's super optimistic. I will go much further as Exxon. Chronic underinvestment. So I insist, this is where we focus, and we think that oil is underinvested. You see the chart. The peak was in 2013, 700 billion, and now we are around 500 billion, assuming inflation, assuming that it's more difficult to bring new resources. I think it's clear that we are underinvesting in oil, and it is clear why. I mean, it's ESG, it's electrification. It is very difficult to convince anybody to put 5 billion in an oil project, to take oil, first oil in 7 years' time, invest there 1 billion now. I mean, I don't think, it's easy. And I think, the way to understand this, for me, is shale oil. We have been very lucky to find shale oil. Shale oil was not found, but started developing in 2013. And in 10 years, they have brought 10 million barrels. So for me, the question is, what would have happened without shale oil? That we would be lacking 10 million now. And where do you get this 10 million? So it's where we are now. We need another 10 million. Where are going where we are going to find these 10 million. So far, we are unable as a team in SIA. We don't really know where we can find these million. So the questions are clear. What would have happened to the prices without shale oil? And what will happen to oil prices if we don't find another shale oil? That, by the way, works at a minimum price of around 70 WTI, 80 Brent. This is the marginal for shale oil. So this is what we think is going to happen. So sorry for the slide. This is the production 2024, around 102 million barrels a day. If you take into account the decline, because when we consume, obviously we consume oil every year, so there is a decline, and then the curves decline. The average, being conservative, is 3%, multiplied by 6 years. We are going to lose 17 million barrels. What is the new supply? On our estimate, it's going to be 5. Basically, it's going to be Guyana, it's going to be Brazil, a little bit Canada, and some spots here and there, but there's no shale oil. Shale oil has been more than 70% of the new oil brought to the market since 2014. We need something like this, a big resource, to offset supply and demand. Demand is going to grow, as I tried to prove, by 1 million barrels a day for the next 6 years. So you have new supply, 5 million, which basically offsets the demand. And you need to basically look for compensating the depletion. So the supply gap in 6 years is 18 million, is 18%. Yeah. We need high prices, $90 minimum, and we need new fields and new resources, and people have to move because we are getting out of spare capacity now. Spare capacity is around 5 million barrels. Effective spare capacity from OPEC is 3. We have 2 years. We have 2 years. And this is a statistical. I like this chart because it tells you statistically what happens when the price normally, when supply and demand are more or less at the same level, there is some inventories. Normally, it has been trading at around 80, 70, 80 Brent. When there is a problem of supply, you go to the second distribution. You go to an average of 150. Why 150? Because as from 150, 160, it is so important for the economy that the economy starts to slow down and demand starts to slow down. So it's a price effect on demand. So these two will repeat. And we think that we have more or less spare capacity because OPEC is cutting now due to the slowdown. But once they bring the supply, in a couple of years, probably we will move to this 140, 150, 160. Copper. Copper is even worse. I mean, copper, because in oil, demand is growing, but not massively. But in copper, the problem is that we have electrification on top of everything. So if you look at copper, this is a chart from Glencore, very, very recent. In today, the consumption is 30 million tons, roughly, of copper. 6 million are scrap, and mine are 23, 24 million tons. We need 60 for 2040. I mean, it's a laugh. It's a joke. If a mine, to bring a mine, you need 15 years, we already need to have mines for 20 million tons, doubling the actual mining capacity, or build a lot of scrap, like full speed. So, I mean, this will not happen. As Carlos was saying, it will not happen. And you can see the breakdown. So basically is low carbon and the electrification. So moving to renewables and electrification of the economy. So it's going to be, the demand is not a problem in copper. As maybe in oil, people are fearing about peak oil that we don't share. Copper supply, well, you know, it's the same. We are not investing since 2013, and we are eating the mines. And you can see that without investment, we will lose 36% of production. This is already happening in Codelco, for instance, in Chile. That is very clear. It's an old mine in Escondida, old mine that is, you know, going down every year. Grades are going down, production is going down. And this is the capex, expansionary capex in copper, I think. Yeah. You see that companies are not investing. They are not investing. So this, I mean, if people believe what I'm telling, that demand is going to go like this and supply is going to go like that, you should be investing already. in order to bring capacity in 10 years' time. This is not happening. Companies are very disciplined. It is very difficult to open a mine. You don't get the license. You get the green guys against you, and it is tough. And this is the resulting project. These figures are from Woodmac, but anyway, I mean, it's the same. It's so easy. It's consensus in the end. If there's no investment, this is what will happen, and this will take the price higher than $7 a pound, and we will be selling, no doubt. We will be selling at 7. The last spot where we are concentrated in the natural resources is salmon, and the story is very similar. I don't want to bother you, but salmon farming is constrained in terms of, well, let's start with the supply. Supply growth, this is historical, value growth, 8%, 2013, 2023. There are some statistic works done that say that if you keep flat prices, demand grows by 8% at flat prices. So you have a strong demand potential there. And also the consumption per capita in most of the countries is very low. So emerging markets, they do not eat salmon. Only Europe, Japan, Norway, Spain are really high consumers, but even the US, they do consume half of what we consume in some countries in Europe. Don't go to China or don't go to India. So the potential demand is massive. So far, statistically, 8% growth per year, and the future is even brighter. If you go to the supply, there's only 2 countries supplying salmon. Norway, 50% of the global supply. Chile, 25%. And these 2 countries, they cannot grow much more. They can grow 2, 3, maybe 4% per year, because if you put too much salmon in the coast, they get illnesses, so you have biological issues and they die. And when you have a nest full of 100,000 fish, if you get a virus, you lose the production, and it's very bad for image and for health. So basically, these sectors are now regulated, and the regulator say, okay, you are doing fine, you can grow a little bit, 2, 3%. If 75% of the supply can grow 2, 3%, then only prices will will balance the equation of supply demand. And this is the supply expected for the next 5 years, according to some experts, is going to be 2%, not even 4%. Growth in the past 10 years has been 3% in supply. There are new technologies trying to bring supply, like on-land salmon farming or offshore salmon farming, but we are really far in terms of bringing this capacity in at a scale level. This is our Pareto estimates on the prices. Obviously, this is what we call a regime change, because this sector is going to be under supply for many, many years, so we will see higher prices. And maybe, I'm asking myself, maybe this will be a luxury product at some point where prices will be too high, although it is true that you can, the substitution. So the salmon price can go up to a level where you eat chicken or another thing. It's not like oil, where oil goes up and you cannot really substitute, or very long term, but in salmon you can always have a sandwich. And the sector is cheap. Yeah, the sector is cheap. Look at this. It's 2025 under 10 times with the valuation, with the prices of Pareto. Prices of Pareto are mid-cycle prices. It's easy to get them, but prices will move from 60, which is the marginal cash cost, to 130, 140, which is the prices where demand, moves to chicken. And the average is 90, so the model is relatively easy to build, and the PE is relatively easy to guess. And you have companies below, you have companies, Greek, you have some extra risks, but you have companies like Leroy, 8 times, Mowi 9 times, Salmar, even Salmar is a great company at 12 times. So the sector is cheap. It should be trading 15 to 20 times. We need to make good money here. So yeah, I'm more or less over. I'm going to talk about our proposition to you and to our investors and our companies. So the first proposition, or the first pillar, is capital protection. So we want to protect capital. We base this on Keynes, that define investment in 2, capital protection and decent return. And this comes from our value experience. So the investment is 2 parts. Protect your capital and decent return. If you go to very high returns, you forget a little bit about capital and you assume too much risk. So this is our key Capital protection, very important for us. Warren Buffett, obviously, never lose money. He's the same. Rule number 1, never lose money. Rule number 2, don't forget the number 1. The whole investment committee, so Alex, Carlos, Urs, myself, our families, our friends are invested, so we are aligned and we will be aligned with all you guys and our investors and companies. So we really feel as partners and we feel the pressure. When the fund goes down, we feel the pressure and we really do not enjoy that much. Although we can buy cheaper, but it's not really a happy moment. As I said, we are fast and we say no to unnecessary risks. So here in commodities, don't take unnecessary risks because it is full of risks. Full. Decent return, so the number is a bit different from the 12 because it was updated on, I think, I don't remember, but yeah, mid-August. But basically, we are happy because the performance is good, it's 13% per year, and the cycle has not yet started. So yeah, we have some copper highs, we sold copper, then we are back to copper, but we are happy, we think we can maintain at least this. As I said, if the cycle goes too high, there is plenty of upside. But we don't want to multiply by 7. We want to protect our capital and make a double-digit return. This is what we want, which basically 10% per year is doubling your money every 7 years. 13% is doubling your money every 5 to 6 years. Obviously, in a longer cycle, so protect capital, decent return. Don't not invest if you're going to stay 6 months or try to trade because it's impossible. In our experience, it's impossible to trade because you have a lot of unexpected things. Now what is going on is that the cycle is depressed. I try to explain. The cycle in China is still low. The cycle in the US is slowing. In Europe is already very low, which means 75% of the demand is depressed. This is why everybody is short. This is why the sector is suffering. And for us, it's an opportunity to buy. And that's it, that's the way, and then enjoy the long cycle. And in the long cycle, we will always have demand fluctuations that go with the economy. What can you do? Because it's very difficult to get out fully. So what would you do is, move into maybe salmon or cables or other sectors or meat casings where we can hide if the sector is too expensive. Valuation, I try to explain, is below mid-cycle, so it's not late to be there. And in our view, this cycle will be much longer than historical because the energy transition is changing the scope of investing. We need to invest not only in tunnels, but in roads, in the grid line. And, it's fantastic to be, with the iPad, in Netflix, and in Facebook. That is fantastic, but we need infrastructure to do the transition. We need green energy, we need the non-green energy, and we think that the new cycle of CapEx and commodities has just started, and it's going to take a lot of time because we need to change the supply. And final word, long term, there's a positive here that I would like to mention, that is some decorrelation, non-correlation with equities over the long term. So short term with the macro, there is a lot of correlation, but long term is one of the few sectors, as you can see on the right, over 10 years, is one of the few sectors that is not correlated with the stock market. So it's a way to diversify always in the long term, because short term, you will be driven by China macro and US macro. And final slide from me, I think, because I always make the same mistake. Our proposal to you, strategic value, quality value in natural resources. We are small and we are not unconstrained, so we do whatever we want, whatever we like. We have a lot of experience. I mean, even if you invest in a big private equity, I don't think they get more experience, to be honest. Normally I'm a humble person, but you don't see people with 30 years experience out there. Risk management, this is an obsession for us. I think every value investor is a little bit obsessed by risk. Track record is, we are proud. We hope we can maintain double digit. Long term, and transparent, trying to communicate with you investors 4 times a year and to big conference. So I think this is important in this sector, to be open. Is going bad, why? Is going good, why? And what we are doing, it's very important, because if you look at the volatility, you can very easily lose faith and perspective. Thank you very much.
We would have now maybe 5 minutes for questions, if there are any. Yeah.
What's your view on the palladium, platinum, gold, and silver metals?
Yeah, good question. On gold, we understand that gold is not an industrial commodity. And as it's not an industrial, it's very difficult to understand what is going on with the demand part of the equation, because you have central banks buying and you have also consumer buying here and there. It's difficult to understand. What we understand is that supply is constrained because there's not a lot of mines out there, and it's going to be difficult to bring new gold, and it's going to be more expensive. So the curves will move up. So our sense is that gold will move up. But we don't invest in gold normally because we don't understand the demand part of the equation. We need to understand a bit better the industrial aspect of the sector. And palladium and the rest of the PGMs, we are not very bullish because of the electrification. So we think that there's an issue with demand in terms of cars and the transition to EVs that use less. Then this can change, and we see capacity. So they are not the type of commodities where we see structural undersupply, but they are not bad commodities. We only would buy them very cheap when they trade below, I don't know, half of replacement cost or half book value to make it easy, and then play it to mid-cycle. We would not play the high cycle. Demand is not clear to us. So we are not, as far as I recall, we are not invested in any PGM or gold. A lot of managers in the natural resources invest in gold as a defensive. Silver the same. Silver the same. It's a well-supplied commodity, and difficult to understand the demand. And it's very small. You know, in the end, if you try to invest in these commodities, you only have few companies. Very, very few companies. Normally, these companies are not pure players. The pure players are too small. So really, in our 20 years experience, it is really hard to have grip on supply-demand, and then it's really difficult to find companies that are quality, large, and you can really say, okay, I'm here. If everything goes wrong, I just buy more.
If I may add, I mean, what's very interesting, if you compare since 27 years, as Urs has shown on the last call that we did, if you compare gold price, which has been the best, among the best commodity prices over the last 27 years, and then the gold mines have been very, very poor. And the reason mainly is because it's so seldom. If you go from 2 grams a ton to 1 gram a ton, you double the cost. Can you then really amortize your investments in trucks over 30 years? You should not. Now, we believe gold mines are as cheap as probably never before, but still they are 2 or 3 times as expensive as industrial mines. So we would advise, if gold and silver, you can buy physically. You don't have to pay a manager. And basically, the last 27 years, you had the best performer. You did, I think, 7 or 8%, and the gold mine is 1 or 2% per year. But the best performing stocks was Canadian Natural Resources and BHP Billiton, or among the best, which are the bulky stuff nobody wants to have. Maybe another question, Beat?
Yeah, you mentioned that you... Okay, thank you. Save my voice. You mentioned a few countries where you don't invest, China, Russia. So I just was wondering, how could you then invest in Kazatomprom in Kyrgyzstan? Is this not on your list, or do you have another view about this jurisdiction?
Yeah, we discussed a lot, and actually some of... so we found, I don't know, 4 or 5 years ago that uranium would do very well. And when supply-demand estimates suggested, well, we need to play uranium, basically demand is going to explode because that's the only way to really help the transition, and there's no supply. Then we bought Cameco. We looked for companies, and we found basically 3 or 4. We found Cameco in Canada. We found Kazatomprom, because these guys are the share.
They're producing 50% of the global production, those two.
And then we found a couple of funds that are investing in uranium. Yellow Cake, and there's another one, Sprott Uranium, I think. So these 4, and we said, okay, what is then? you do the numbers, and this is IRRs with the mid-cycle price. We take the investment committee, and the investment committee, some of us were saying, let's not make the same mistake we made with Ukraine or with Russia. Let's get out of... And the final conclusion was, okay, let's buy Cameco big, and let's buy Kazatomprom smaller. With time, Kazatomprom is up a bit, so it's now close maybe 5%, which is going to be our limit. And yeah, that was the reason. You know, we wanted to be exposed, and you need to make a decision. So the decision was this one: we take this risk on Kazatomprom because overall the risk was not kind of huge for the portfolio. But it is a very fair question, and this is why the investment committee is very important.
And then in addition, we still have
maybe
three Russian stock in the portfolio that are currently valued at zero. Nevertheless, they are trading locally in Russia for a pretty attractive price.
And maybe to say, Cameco, which trades on 50 times earnings at the moment, depending always what you expect. Do you know where the uranium is coming from Cameco? They have two operating assets at the moment. One is Cigar Lake, and the other one is the Inkai joint venture, which is actually with Kazatomprom. So, and you know who is the biggest operator and operates the biggest uranium mine in Kazakhstan? It's the French government. So it's a joint venture with Orano, which owns a majority, and Kazatomprom has a minority. So, but you never know, but actually it's actually operated by the French government. So maybe it's not such a different risk, even if it's
close,
a different jurisdiction.
Maybe a last question, because before we go then down to lunch, if there is one, otherwise we can save that for lunch. Now I would like to have Emil on the stage, and I would like to have as well Heinz or Armin on the stage, because our technicians have their last event today, and we would like to actually thanks a lot for Emil for coming.